Welcome back to Charged Alpha. Ryder System printed Q1 2026 earnings on April 23rd, and the stock did something unusual. It hit a 52-week high of 246.92 on report day.
Up 82% from the year-ago low of 133. EPS came in at 254 versus 229 consensus, a 10.9% beat. Revenue at $3.13 billion missed by 0.5%.
So the market rewarded the bottom line beat and ignored the slight revenue softness. That tells you something about where freight cycle psychology has shifted. Investors are looking through the trough.
And the buyback was aggressive. $233 million repurchased in Q1 alone. That is shareholder-friendly capital allocation at a moment when management clearly sees value below the current print.
Lana, set the stage on the business itself. Because Ryder is one of those names everyone has heard of, but few investors really understand the segment mix.
3 segments. Hudson, Fleet Management Solutions is 49% of revenue, truck leasing under the Choice Lease brand, plus commercial rental and maintenance. Supply Chain Solutions is 32.4%. Dedicated Transportation is 18.6%.
That FMS segment is the historical core, but the strategic pivot has been toward the embedded businesses. Sanchez deliberately moved capital toward outsourced logistics to dampen used truck residual volatility.
Exactly. And the moat is genuinely hard to replicate. 235,000 vehicles under management, 6,500 maintenance locations across North America. That physical infrastructure is decades of capital expenditure layered into the ground.
Plus 3 to 7 year contracts in FMS and DTS. Supply chain customers have months of transition costs to leave. RyderShare platform layers software differentiation on top of the asset base. This is sticky revenue.
Now to the why now question. Forward EPS growth is nearly 40% from FY 2025 to FY 2027 consensus. From $12.88 to $16.73. Cycle leverage is real if freight normalizes.
And valuation supports the case. EV/EBITDA at 6.43 times is well below historical averages. PE at 19.4. The market is paying mid-cycle multiple for what could be early-cycle earnings power.
Q1 was seasonally the weakest quarter of the year, and they still beat by almost 11%. Q2 estimates already call for $3.63 EPS, up 43% sequentially. The acceleration is starting now.
Let's talk about the man steering this. Robert Sanchez, chairman and CEO since 2012, joined Ryder in 1993. This is a 33-year veteran of the company running it.
2 strategic transformations under his belt. He sold the international operations to focus North American capital. Then he pivoted aggressively toward supply chain and dedicated transport to reduce dependence on volatile used truck residuals.
That second pivot was contrarian when he made it. Asset-light advocates were criticizing the model. Sanchez doubled down on physical infrastructure plus embedded contract revenue. The current results vindicate that conviction.
He also rebuilt the dividend after the pandemic cut. 22 consecutive years of dividend payments, $3.54 annual rate, 1.46% yield, 29.5% payout ratio, disciplined return of capital.
Capital allocation under Sanchez has been textbook industrial discipline. He bought back stock when shares were depressed, paid the dividend through the cycle, and reinvested into the higher return segments.
MBA from University of Miami. Analytical approach. He is highly respected across the transportation industry for understanding fleet economics at a granular level few CEOs in this space genuinely do.
Now into the numbers. Lana, walk through what came out of this print and the trailing 12 months underneath it.
TTM revenue $12.66 billion, TTM EPS $12.50, TTM net income $499 million, gross margin 26%, EBIT margin 6.8%, net margin 3.9%.
Margins are recovering from the FY 2024 trough. Net margin was 2.9 in 2024, now 3.9 TTM. That 100 basis points of net margin expansion on $12+ billion of revenue is real operating leverage.
Operating cash flow $2.53 billion, CapEx negative $2.05 billion. But remember that nets fleet disposal proceeds against purchases. Free cash flow $478 million TTM is the cleaner number.
Balance sheet is the inevitable conversation. Total debt $8.68 billion, Cash, $198 million. Net debt, $8.48 billion. Net debt to EBITDA at 2.55 times.
That leverage is structurally embedded in the leasing model. You finance the fleet. The question isn't whether debt is high in absolute terms, it is whether residual values support the asset base. Right now, they do.
ROE is 16.3%. That tells you the equity is being efficiently deployed, even with $3.05 billion of total equity against $16.4 billion of total assets.
PE 19.4 times, EV/EBITDA 643, PS 076, PB 336. The EV/EBITDA is the headline metric for industrial leasing names, and 6.4 is genuinely cheap historically.
Quarterly revenue trajectory shows the cycle bottoming. Q2 2025 3189, Q3 3171, Q4 3175, Q1 2026 3126. Flat for 4 quarters running.
But EPS tells a different story. Q2 2025 311, Q3 357, Q4 359, Q1 254. Margin expansion is delivering earnings growth even with revenue stalled. That's operating leverage in action.
Annual EPS history is instructive too. FY 2022 was $17.82 at peak used vehicle prices. FY 2023 dropped to $11.18 on normalization. FY 2024 $12.42. FY 2025 $12.88.
And the forward path, FY 2026 E 1401, FY 2027 E 1673, FY 2028 E 1957. If the cycle plays out, you compound earnings at 15% for 3 years from here.
Now Street thinks. 12 analysts cover the name, 7 buys, 4 holds, 1 sell. Mean price target 240, stock is at 240, 259, essentially zero upside priced in.
That is the contrarian setup, Hudson. Consensus has not caught up to the print. Citi at 285 buy, Morgan Stanley 268 overweight, Barclays 255 overweight, Wells Fargo 252 overweight.
The bull camp sees 15 to 20% upside. Goldman 248 buy, Baird 245 outperform, Susquehanna 240 positive. The bears anchor low, Stifel 195 hold.
Wolfe Research downgraded from outperform to peer perform on January 8th, calling out valuation concerns after the run. Morgan Stanley went overweight in December 2025. Barclays moved to overweight in October.
So the directional flow has been positive bias from major shops, with Wolfe being the outlier downgrade. Mean target should drift higher post-Q1 print as estimates get revised. Watch for revisions over the next 2 weeks.
Bull case, Hudson, 5 points. First, used truck price normalization as the 2021-2022 fleet surge digests. Residual value gains rebound, boosting FMS profitability with operating leverage on a fixed cost base.
Second, freight market recovery in 2026 as inventory destocking ends and shipper volumes normalize. That drives dedicated and supply chain demand. Both segments scale revenue without proportional asset additions.
Third, choice lease multi-year renewals are pricing higher. Tighter new truck supply and Ryder's maintenance network are commanding premium lease rates. This is the kind of pricing power that compounds for years.
Fourth, EV fleet management. As fleets navigate the electric transition, the complexity favors outsourced expertise. Ryder is positioned as the preferred partner for that operational headache. Margin accretive over time.
Fifth, the buyback, $233 million in Q1 2026 alone against a $9.5 billion market cap. Annualize that and you are looking at potentially 10% of float retired. EPS gets a structural tailwind.
Bear case now. Lana, push back. What breaks this thesis?
First, freight recovery slower than expected. If economic growth disappoints in 2026 and 2027, excess capacity lingers and rate negotiations stay weak. The earnings ramp simply doesn't materialize on the consensus timeline.
Second, the leverage. $8.7 billion of debt against $3 billion of equity. If used commercial vehicle prices crack on a new truck production surge, residual values impair and the balance sheet gets exposed quickly.
Third risk follows directly. New truck OEM production has been disciplined, but if Class 8 builds accelerate to meet pent-up demand, the secondary market floods and FMS resale gains compress. That's the cyclical hammer.
Fourth, fuel and driver wage inflation. DTS contracts have varying degrees of cost pass-through. If labor costs accelerate faster than contract escalators, dedicated transport margins compress in mid-contract years.
Fifth, customer concentration. Top 10 customers are a meaningful share of contract revenue. Losing one major supply chain or dedicated agreement creates outsized P&L impact and forces awkward fleet redeployment.
Those are real risks. Worth noting that Sanchez has navigated each of these before. The 2023 used truck reset was severe, and the company managed through it without distress. Track record matters.
Peers comparison: Hudson GATX trades at 182 times sales with 4.5% revenue growth. Air Lease at 320 PS with 8.2% growth, both pricier on sales but different exposures.
CH Robinson at 045 PS with negative 1.8% revenue growth. Pure freight broker, asset light. Trading lower on sales but no fleet to monetize when residuals turn favorable. Different model entirely.
XPO at 068 PS with 3.5% growth. Closer comp on the LTL side. Ryder at 076 PS with negative 0.2% growth sits in the cycle trough on revenue but with better margin recovery.
The right way to think about it: Ryder is cheaper than asset-heavy peers like GATX and Air Lease, while owning operating leverage that pure brokers like CHRW lack. Sweet spot of the comp set.
Options activity post-print is strongly bullish. Call volume is exceeding put volume 3-to-1 in the week after earnings. 250 and 260 calls for July 2026 expiration saw heavy open interest builds.
Implied volatility compressed since the print. That is the bullish signal. The market is pricing continued upside without paying for protection. When IV compresses on a beat, sophisticated money expects the move to extend.
Insider activity is the most interesting tell. RSU vesting sales from executives are routine, but multiple directors and SVPs made open market purchases in Q4 2025 when the stock was 140 to 160.
That is prescient buying. Stock has nearly doubled from those levels by April 2026. When insiders deploy personal capital at 52-week lows and the thesis plays out, that is the kind of signal investors should weight heavily.
Bottom line scenario tree: bull case, freight recovers in second half 2026, choice lease pricing holds, buyback continues. FY 2027 EPS reaches 1673 or higher, stock targets 280 to 300 range.
Base case, gradual recovery, EPS hits 1401 this year and grows mid-teens, stock compounds from here. Mean reversion of EV/EBITDA towards 7.5 gets you a meaningful re-rate alongside earnings growth.
Bear case, freight stays sluggish, used truck prices weaken, EPS guides lower for F 2027. Stock retraces to 200 or below, leverage becomes a more acute concern. Dividend safe but multiple compresses.
Two metrics to watch: commercial rental fleet utilization and choice lease yield. Those determine whether the capital-intensive fleet is being sweated efficiently at profitable rates. Quarterly disclosures are the tell.
Also watch the buyback pace. If Sanchez maintains $200 million plus in Q2 2026, that is conviction. If it slows materially, that is a signal. Management thinks the easy multiple expansion has happened.
This is the kind of name where the cycle setup, valuation, and management quality all align. The risk is that you are buying at a 52-week high, but the fundamentals support the print. That is the dilemma.
For investors weighing entry, the question is timing. Wait for a pullback to the 220 area, or accept current levels given the earnings ramp. Both arguments are defensible based on your time horizon.
That is a wrap on Ryder System. If you found this useful, share it with a colleague who covers transportation and industrials. Subscribe for our next earnings deep dive. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo. That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.